Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Brian Madden is on the show today. He's Chief Investment Officer at First Avenue Investment Counsel, and we'll be taking your questions on North American equities. Here's how you can reach us. You can call us toll-free, 1-855-326-6266, or you can send us an email at marketcall@bnnbloomberg.ca. And Brian, of course, joins us in studio. It's good to see you. Thanks for coming in.
Likewise. Good to be here.
Yeah, I mean, it's been an interesting 2026 so far. It's only been about a month and a bit, but I wonder what trends you're seeing, because you were saying there's some long trends in the market that you're seeing being disrupted a little bit. What do you mean by that?
Yeah, I mean, it has been an interesting start to the year, and abstracting from all the geopolitical intrigue, which seems to be a regular recurrence these last 13 or 14 months. Under the surface in the market, there's a lot of sort of long-established trends that we're seeing starting to quiver a little bit. So notably, and this is sort of a fresh and welcome sign in our thinking, we're starting to see signs of the U.S. equity market broadening out, the proverbial rising tide lifting all boats rather than just a select and magnificent few. And so to wit, we know that the Magnificent Seven stocks that have so dominated the index returns last couple of years are actually down low single-digit percentage year to date. The S&P 500 is down 1% or was as of Friday. However, the equally weighted S&P 500 is up by about 5%. And even more tellingly, the Russell 2000, which is the U.S. small cap index, is up about 7 or 8%. So, that's one thing. And then sectorally, we're seeing leadership invert from what we saw last year, with the energy and the consumer staples sectors, which lagged last year, at the top of the leaderboard, and technology, the laggard year to date so far.
Why is that more telling to you when you're looking at small caps and how they're performing so far this year?
Well, we're seeing an environment that is, what we call Goldilocks, where you've got economic growth accelerating, you've got inflation moderating, and you have, in all likelihood, a more dovish policy stance on the part of the U.S. central bank. Of course, Canada has been there longer and faster. And that tends to be an environment where markets broaden out. And we think markets with broad-based leadership are fundamentally more robust and show greater underlying health and resilience than those that are just led by a narrow, small group of stocks. The analogy we like to sometimes use is, in order to gain ground in battle, the troops need to be advancing and not just the generals. And really, we've seen the generals outstrip the troops by leaps and bounds over the last 3 years. So we're starting to see that change.
But despite all of that, like you say, you've been trading more in the month of January than usual. Is that correct?
Yeah, so we were seeing a lot of inflection points, whether it was things like, inflection in manufacturing versus services, whether it was sort of this rotation away from software and the Magnificent Seven into more old economy and hard asset types of businesses, or whether it was trading ahead of a frothy blow-off in the gold complex, which had been really demonstrable leadership in the Canadian market for certainly the last year, if not longer. We probably had twice the level of activity in our two equity mandates, our dividend growers and our momentum mandate at First Avenue Investment Counsel, that we would have had in a typical month over, let's say, the last year or so. So, for us, this is good. Some people don't like volatility. To us, volatility is opportunity, and so we seized upon inflection points and spotted some opportunities and capitalized.
Interesting. Okay, we're going to take a quick break now, but we will be back with Brian Madden of First Avenue Investment Counsel, taking your questions on North American equities right after this. Welcome back. Brian Madden joining us today for Market Call, taking your questions. We're going to start with an email question, this one coming in from Wu, and it reads, what is holding back the shares of Canada's railways? Do you favor going forward 3 or 5 years, and why. Okay, so Brian, the state of Canada's railways, let's start there. What's holding them back?
Yeah, I think the answer to this one, Lindsay, is simple, and thank you for the question, Wu. So in a word, 2 words, I guess, freight recession. The transportation executives have been talking about this for quite some time, and we've been observing it ongoing for over 3 years. And so if you think about what's underpinning that, it's manufacturing, because of course services don't need to be transported, whereas goods do. And we have seen manufacturing in contraction or muted growth for until last week, according to the Institute for Supply Management's Purchasing Manager surveys, which have printed below 50, which is the boundary between growth and contraction, in 36 of the last 38 months, dating all the way back to 2022. And remember, everyone was stockpiling treadmills and hot tubs and bread makers and all their COVID binging stuff. And then they switched to favoring the FOMO experiences and travel and concerts and what have you. And so a lot of demand got pulled forward. A lot of manufacturing faced headwinds, and accordingly downstream of them, so did the transports. That is now starting to change. So we saw the ISM Manufacturing Purchasing Managers Index spike unexpectedly to almost 54 last week for the month of January. Its first sort of poke above water in over 3 years. So what we've got for the rails is easy comparisons. You've got 2 Canadian rails, and I would say it's a tale of 2 cities there. One is deeply discounted. The other one is trading more or less at parity with the group of Class 1 rails, the 5 North American rails. So CN is the discounted rail. CP is the one that's trading at parity with the group and kind of in line with its historic multiples. And just to put some numbers to it, if you're looking for value, you buy CN. It trades at 17.5 times earnings. It yields 2.7%. The yield is a meaningful premium to its 10-year average at 2%. The PE is a several multiple point discount to its 10-year average. On the other hand, you've got CP, which trades at 21 times earnings and has a yield just under 1%. So not particularly cheap, but the advantage with CP is it's expected to grow faster with a 13% compound pace of earnings growth over the coming 3 years, whereas CN is expected to grow at 8%. If we were to pick one over the other, it would probably be CN on the grounds of the valuation discount. And also, we prefer the mix of business. They've got relatively more intermodal in the mix, relatively less auto, just thinking about the outlooks for those 2 different segments. But I think the bigger picture is both of them should do well as manufacturing recovers and freight and, of course, transportation recovers. However, that said, we don't own either of them, and that's because we have an even better idea within transports, and that's trucking, because trucking has way more cyclical leverage to a recovery in freight and transport volumes.
Okay, interesting stuff. All right, we're going to move on to a phone call now. Peter is calling in from Niagara Falls with a question. Hi, Peter.
Hi, good afternoon. Thank you for taking my call. I'm interested in adding a life insurance company to my portfolio, and I'm looking at Great West. Brian, can I please have your opinion? And Lindsay, can you give me the street estimate? Thank you. I'll hang up and listen.
Thank you. All right, Brian, you go first while I look that up.
You betcha. Thanks for the question, Peter. We don't own Great West Life or any of the life insurers for that matter. We do own some of the property and casualty insurers. However, don't think it's a bad time to be thinking about a life co, and you could certainly do worse than this one. One of the 3 or 4 big players in Canada, alongside Sun and Manulife and Industrial Alliance. This one, more so than Industrial Alliance, has a good size U.S. business. Sun Life and Manulife also do. They're big in the protection part of the business, life insurance policies and health and disability and so on, but also in accumulation plans, so that's group retirement and group benefits programs. And increasingly, they're a factor in the record keeping and back office administration with some of the acquisitions they've made in the United States. This is controlled by Power Corp, which is a supportive long-term shareholder. I think the basic algorithm here is you get the dividend. I don't know exactly what the yield is right now, but ballpark figure probably close to 4%. And historically and aspirationally, this company intends to grow the dividend at a high single-digit pace. So you put those two things together, the current income plus the prospective growth in the dividends, which usually translates into capital appreciation, and you've got a pretty good line of sight to a high single-digit or low double-digit rate of return over a cycle. I also think the banks, although we do own core positions in the banks, they've re-rated meaningfully higher. And it probably won't be too terribly long before some people start to think there's a relative value trade opportunity between the banks and the life cos, because they tend to trade at close-ish parity to one another, and the banks have re-rated more so than the life cos recently. So no quarrels with buying this one, although we ourselves don't own it at the present time.
Okay. And Peter, consensus on that is 5 buys, 7 holds, and 1 sell, and then a 12-month target of $67.09. We're going to move on now. Another caller, Elliot, calling in from Hamilton, Ontario, with a question. Hi, Elliot.
Good afternoon. Citigroup has been making significant progress operationally on its margins and profitability. Would you consider starting a position today at 125? Thank you.
Okay.
Thanks, Peter. Not a terrible idea, although, and so I don't want to pour cold water on it altogether. I think, we think the money center banks are advantaged structurally relative to the regional banks, let alone the thousands of small community banks and very niche players in the United States, because banking globally, but particularly in developed markets, is increasingly a scale and technology advantaged business. Case in point, a rough and ready example from here in Canada, we're seeing Laurentian Bank go dark with the acquisition of that small subscale bank by a consortium led by a private company buying the specialty business, a national bank taking their traditional deposit and lending operations. Similarly, you saw national banks swallow up Canadian Western Bank. So the moral of the story here is the big get bigger. The only reason we would be somewhat reticent to buy Citibank is just because the opportunity costs of buying that bank might preclude you from buying a better money center bank. And in our view, the better money center bank, in fact, the best money center bank, and I'll even declare the superlative, we think it is the best bank in the world, and it's JP Morgan Chase. So given a choice between the two, we'd favor JP Morgan Chase, but you'll probably do fine with either one of them, frankly.
All right. We're going to take another quick break right now, but we will be back with Brian Madden of First Avenue Investment Counsel. He's taking your questions on North American equities. We'll be right back. This is how you can reach us. Welcome back to Market Call. We're going to get right to the phone lines. Nazar in Scarborough is calling in with a question. Hi there. What's your question?
Oh, hi, Nancy. Hi, Brian. May I have your thoughts on Allied Properties REIT, please? You had spoken very highly about this REIT, but they cut the dividend by, I believe, 50%. The stock is range-bound at around $14. When do you think they will restore the dividend? And are you continuing to hold this? Thanks for taking my call.
Okay, thank you. Yeah, yield is now just over 5%. What do you think about Allied Properties?
Yeah, I mean, this one has been, candidly, Nazar, a bit of a bumpy ride. We bought it a while back, I want to say late 2024. Proves to have been a bit premature. As you noted, they did cut their distribution. I think it was maybe closer to 60%. It had been yielding 12-13% late last year, and they made the difficult decision, their board of trustees, to lower the distribution to shore up their balance sheet and preserve some financial flexibility. I would say that our ingoing thesis was right on one count. They have iconic trophy assets, about 13 million square feet of mostly office and a bit of commercial space, clustered densely in Toronto. Of course, this is the company that revitalized the formerly industrial and warehouse strip along King Street West and the Front Street corridor in Toronto. They also have some good 5 or 6 million square feet of space in Montreal, and then a few million rounding it out elsewhere in Kitchener-Waterloo and Calgary and Vancouver. So the core thesis was that office occupancy would return slowly but surely to pre-COVID levels. That's been slow to come, but we are seeing tentative signs. The provincial government has ordered its staff, kicking and screaming, I might add, back to the office 5 days a week, and the banks have all taken similar steps. So, we're going to absorb this surplus office space, and the operating leverage for a landlord, a real estate investment trust like Allied, when occupancy returns, is tremendous. And so while we were somewhat surprised and disappointed to see the distribution cut, we're sort of grudgingly accepting that it was bitter medicine, but a necessary step to take given the slower than expected return to normal occupancy. But we think that the intrinsic value, or let's say the private market value, if a pension fund or a strategic acquirer were to take a shine to this company, is much, much higher than the current share price. It's trading at 0.4, 0.5 times book value, which is not just a figment of their imagination, because they've been divesting non-core properties steadily to deleverage their balance sheet, generally speaking at the full IFRS book value. So, if someone were to take a run at them and want to take them out, it would probably be in the high 20s or possibly a higher price. So we're going to be patient with this one, but concede it's been, not exactly the path we had foreseen.
And I know Nazar seemed concerned about that dividend cut. Do you think there's any point that this company would restore that dividend, or maybe not in the near future?
Probably not in the near future. Typically the pattern, and I will say, in my tenure, in my current role, this is the only company we've had cut a distribution, and we make our whole stock and trade in owning companies that grow their distribution. So this one's a bit of a dark horse and an outlier. But, just knowing as a student of the market, what happens is the company cuts the distribution, the business fundamentals stabilize, and they sort of bide some time to make sure that they can really legitimately sustain a heightened distribution before they take the step of, sticking their neck out and increasing it again. So we think it's a question not of if, but rather when. But the when is probably not this year, not next year, sort of time frame.
Okay. We're going to move to the phone lines again. Henry is calling in from Sydney, Nova Scotia with a question. Hi, Henry.
Hi, how are you? Thanks for taking my call. Great show. Brian, Iridium, BRT. It's like a cooling system, and I try to get into the back door of some of these AI and chip stocks and did a little research. And we all know going down the road, if the car gets too hot, you're in trouble with the engine. So I'd like to hear what you think of this company and for the long term, especially. Something about the management, Brian. I haven't seen too much on that. Thank you.
Okay, thanks very much.
So, Henry, I'm a bit puzzled by the preamble to the question, AI and cooling systems, because I had been given to understand that we were talking about Vermilion Energy, which is a natural gas producer. So I apologize, but I have to plead ignorance. If there is another Vermilion, an industrial company, I regret I'm not familiar with it. I do know Vermilion Energy. It's a natural gas producer, if by chance that is the one you're asking about. It's not one we own. Their production is mostly in Western Europe. We're more favorably disposed to Western Canadian nat gas producers, given increased egress through the LNG terminals and what have you. So hopefully that doesn't take you too far astray, but I think you may be asking about a different company than I thought you were.
Yeah, okay. We'll move on to another caller while we get that sorted. Sal is calling in from Vancouver with a question. Hi, Sal. What's your question?
Hi, Brian. Your thoughts on Thomson Reuters at these levels? What do you think of this? What do you think of this company? Thanks.
Okay, thank you.
Thanks for the question, Sal. This is an interesting one. We don't own Thomson Reuters, but it's been piquing our curiosity in the last couple of weeks and months. The stock has been cut in half since last summer. And this stock really encapsulates in sort of a microcosm all of the consternation that's been roiling the markets and the rotation, Lindsay, that we spoke about at the top of the hour about software and software as a service and the risk of disruption by AI, which only accelerated after Anthropic released that new LLM, which purports to disrupt legal professionals. And of course, Thomson Reuters is the dominant provider of software and data and systems to legal professionals. Westlaw is sort of the de facto gold standard that is licensed by almost every major law firm in the world. And so we think sort of superficially that the sell-off is overdone here. And I think a lot of the fears about AI disrupting some of these software and software as a service businesses is legitimate because AI is making groundbreaking advances in a lot of areas. But if there is any sort of proprietary mode in a business, the companies that we talk to would contend that it is data and sometimes network effects. So in the case of Thomson Reuters and Westlaw in particular, there's 100 years of case law, including sort of analysis of it that is theirs, proprietary. And Westlaw is increasingly layering on AI tools and LLMs to sort of capitalize on that proprietary data. So, with all due respect to Anthropic, which is not 100 years old, this company is very, very old. The origin story is, they were the founders of the Globe and Mail, but of course it's pivoted in many directions and has become digital now and is a dominant player in law. We think Anthropic is going to have their work cut out for them to dislodge Westlaw. So with the shares really having rolled back all their gains over the last 3, 4, 5 years, trading at a multiple we haven't seen in quite some time, and a dominant franchise. It's starting to get interesting here, but we haven't taken a position as of yet.
Yeah, definitely starting to get interesting now. Okay, we're going to take another quick break right now, but when we return, we will take a look at some of Brian's past picks. That's coming up next. Stay with us. Welcome back. Time now for past picks. Some of Brian Madden's past picks. These are from January 17th, 2025, so just over a year ago. And we're going to start with Costco Wholesale. Recommended at $943, just over that. Now it's just over $1,000, so total return of 7%. This did pretty well for you. Still holding this one?
Yeah, I can't complain. We still own these shares. This is a company that's been a tremendous value creator and a serial grower and compounder for going on 4 decades now. It really needs no introduction. It kind of pioneered the concept of club and warehouse retailing. Now spans over 900 stores, mostly in the U.S., but internationally, certainly here in Canada as well. And I think really the secret sauce here is an ongoing ability to surprise and delight their customers. This is a company where we really like the culture, the governance, and the idea, the way they embrace sort of stakeholder capitalism. It's not just about squeeze the staff, squeeze the customers, and maximize profits for shareholders. The shareholders do rather well, extremely well over time. Staff are very well paid, and the customers are always surprised and delighted by the values and the experience they get in store. And the basic business model is generate recurring revenue via the membership fees. There's some pricing power. They usually increase them by $5 every few years. Been a few years since they've done that, so maybe another one comes down the pipe soon. Could be a catalyst. And then they keep a narrow assortment of items in store, so they're not trying to be all things to all people. And they have very good procurement and pricing and merchandising, and it's all rolled up rather nicely, such that they are certainly by far the biggest and the best club and warehouse retailer anywhere in the world. And there's international expansion and lots of ways to win here, we think.
I remember, was it near the end of last year, there was some concern about membership renewal and maybe not as many people renewing their membership at Costco. It doesn't seem to have really hurt them, though.
No, I mean, the membership is pretty sticky because you think about the cost of it. It's, I don't know, $60 or something like that more if you get the premium or corporate membership. But if you shop there often enough, your membership pays for itself. And the other nice sort of flywheel effect, part of that is that it engenders loyalty. You've got this sunk cost on your household budget or P&L of $60 every year. So you could go here that's closer, but you've already spent the $60. So it locks in a lot of wallet share at one retailer rather than having people comparison shop. So yeah, it's played out quite nicely. Yeah.
Okay, your next pick is TD Bank. When you picked it, it was at just over $83. Now it's at $132. Return of 59%, total return of 64. Still like TD? Maybe not your favorite bank, but you still like it?
Yeah, I would say it's sort of shuffled a little bit in our pecking order of favorites among the Canadian banks. We still own it along with two other banks. We took partial profits in it partway through that re-rating last year. At the time we picked it, I would say it was probably a contrarian or a dark horse idea, if you can, if you can even make such an assertion about a Canadian bank. But relatively speaking, it was one with, sort of a dark cloud hanging over it. They had just put behind them the $3 billion fine with the U.S. regulators. They had accelerated the succession plans for their CEO, quite rightly so, given the failure of board governance in that organization. And they turned over half their board. So to us, it was fairly apparent that they were turning over a new leaf and that the bank had been tarnished by its misdeeds in the United States, but not irreparably so. And so we saw a strong and dominant franchise with a good plan to claw back what it had lost through the years of mismanagement. And under their new CEO, Raymond Chun, who I heard from firsthand at their investor day last fall, they've articulated a very good plan to continue to grow their earnings and their dividend at the high single-digit pace they've aspired to and succeeded over multiple decades. And the market quite rightly has repriced the shares higher. So we're pleased to see that. Trimmed some profits, reallocated them elsewhere, but continue to maintain a core position in this bank.
Okay, last past pick is Broadcom. We were just talking earlier about the software sector and what happened last week with it. But Broadcom, when you recommended it, it was $237. Now it's at $338 or just over that. Total return of 44%. Thoughts on Broadcom now?
Yeah, I mean, we like it. We continue to own it. We trimmed it as well late last year ahead of their earnings in December and sort of sidestepped a bit of a downdraft in it. It's trading well off of its highs, but we continue to have a good sort of multi-year outlook on this company. It's at the forefront of AI compute chip innovation, and it's also got a pretty big and entrenched business in other legacy applications, industrial and cell phones and laptops and servers and the like. And there's a software business in there as well, where there's real pricing power after they acquired VMware 2 or 3 years ago. So a good exposure. And although not quite Magnificent Seven, it was sort of on the come and was, I think, the 8th largest company in the S&P 500 and looking rather brilliant and magnificent for much of last year. And we think it will shine again going forward. Well,
because the Mag 7, all like that aggressive spending we heard from Alphabet last week, benefiting Broadcom potentially, right?
Yeah, I mean, this is the interesting thing. We didn't get a chance to talk about it in the top of the hour, but one of the things that we're seeing and noting with some interest is investors increasingly seem to be more discerningly parsing winners from losers in the whole AI thematic trade, which was very monolithic and moving all as en bloc for a couple of years. But now I think people are starting to think critically about the massive capital expenditures the hyperscalers are splashing out and thinking, okay, well, how are they going to monetize it? But what we know is right here, right now, the foundries and the chip designers are making hay like there's no tomorrow because these companies are gobbling up chips as fast as they can make them. And then, ultimately down the road, we think downstream of the hyperscalers, people will have application layer uses for these LLMs that they'll be able to monetize. And we're thinking of other ways to win as well, like natural gas and uranium, electric power generation to fuel the massive electricity demand. So, it's starting to be more of a have and have-nots market, but we do think that, certainly for now and for the next few quarters, if not longer, Broadcom is going to be one of the haves.
Okay, we've got a lot of questions for you coming up, so we're going to take a quick break. We'll be back with Brian Madden of First Avenue Investment Counsel, taking your questions on North American equities right after this. Welcome back to Market Call. Brian Madden's here taking your questions today, and Dimitra is calling in now from Fredericton, New Brunswick, with a question. Hi there. What's your question?
Hi, Lindsay. Hi, Brian. I have a question about TMX Group. The question is, since TMX owns a significant portion of revenue outside of the new listings, how sensitive is the stock really to IPO slowdown versus trading, clearing, and data services activity? And does Brian think it is trading at a good price? Thank you so much. I'll hang up and listen.
Okay, thanks for your question. TMX Group, yeah.
Thank you, Dimitra. A very timely question. TMX, of course, the parent company of the Toronto Stock Exchange and the Ventures Exchange, just reported their fourth quarter results late last week. So I had the opportunity to go through those in detail and attend the conference call discussing the results. The results were very good. The dividend was increased. To the meat of your question, concern about risk of a downturn in new listings. I think the company reported a couple $100 million in revenue, of which about 2.3 million was fees from IPOs, thereabouts. So there's four segments. There's capital formation, so that's new listing fees for either companies or ETFs, sustaining fees, so you're already listed and you pay them a perpetual license fee to stay listed on the exchange, and then fees for additional capital raising. So that's a small segment. There's an equities trading and settlement. They also own the clearing corporation, so they get revenue for secondary market activity traded on TSX, Ventures, and the Alpha Alternative Exchange. Beyond that, there's an equity derivatives trading and settlements business. That's the Montreal Exchange and the related clearing corporation, and they also own an interest in the Boston Options Exchange. And finally, the biggest segment is global insights and analytics. So this is kind of a software and data business that's totally divorced from equity offerings and issuance fees. So long story short, I would say they're not particularly exposed to a downturn in IPOs or equity issuance, although it's nice gravy for the overall business when they have a big quarter, as they did in the fourth quarter. There was a lot of financings, notably in resource and mining. The stock has come under pressure in recent weeks for some of these same concerns we talked about earlier, vis-a-vis the global insights and solutions business, which is ostensibly a software and data business. We think the proprietary nature of that data and also the strong and self-reinforcing network effect of some of these platforms very, very effectively insulates it from any AI-related disruption. So the pullback, in our view, is a pretty compelling opportunity for new or existing investors to get involved or more involved, we think.
Okay, back to the phone lines now. Ed is calling in from Burnaby, BC with a question. Hi, Ed.
Hi, good morning, Brian. My question is on Power Corporation. After a nice long runaway going up, it's come off about 15%. So my question is, in your opinion, is this something sector-specific or more related to PowerCore itself? And I know you also alluded earlier to Great-West Life, which is a key segment of PowerCore. So in general, I'd like to get your thoughts on PowerCore, Brian. Thank you very much.
Okay, thanks, Ed.
Thanks for the question, Ed. Yeah, I would say the pullback is probably more sector-related and less so to do with PowerCore itself. So, we looked earlier at the chart of Great-West Life. Power owns the majority interest in that business. So to some extent, the way that Great-West trades, it's going to rhyme with how Power trades. So they have similar shaped charts. That's not surprising. Beyond that, they also own the controlling stake in Investors Group, which is an investment management, asset and wealth management business. Both very good cornerstone businesses. And then they've got a collection of other unrelated businesses, some in Europe and elsewhere. And then one of the really interesting pieces of this is Wealthsimple. So Wealthsimple is currently private. It was started by its founder, but it's done various private market equity issuances, and Power Corp has been a cornerstone investor in it for some number of years, and they're growing really, really fast. I think when we heard from them a year ago, they had just breached 50 billion in AUM, assets under management. They're trying to get to 100 billion. We think they're probably ahead of pace with some aggressive new account opening and client onboarding initiatives. We think there will likely be a liquidity event for that business, which we think may be cash flow positive already or soon to be. And that could unlock some real hidden value in Power Corporation. So, this is a company that has really played this sort of revolution and democratization of financial services and investment and wealth management businesses very well. They've got two old incumbent legacy players in insurance and group retirement and benefits, which are slow and secular growth. Slightly faster organic growth business is the Investors Group, a traditional investment management business. And then the disruptor, they also own a big block of through Wealthsimple. So in some sense, they're kind of hedged should fintechs like Wealthsimple disrupt their legacy businesses. So a very robust three-legged stool in our opinion, and solid current income via the dividend, and a pretty good and steady and visible runway of dividend growth in front of them. So we think the pullback's viable, although we ourselves don't own it here today.
All right, we're going to take a quick break right now. We'll be back, though, with Brian Madden of First Avenue Investment Counsel taking your questions on North American equities right after this. Welcome back to Market Call. We're going to go straight to the phone lines. Tara Verne, Sierra Vista, Arizona, is calling in with a question. Hi there. What's your question?
Hi. My question is on Roper Technologies. Now, over the past 10 years, they've moved from hardware to a recurring software type business. And then, of course, artificial intelligence happened. So how big of a risk is AI to its business? And do you see some value in it going forward? Thank you.
Okay. Thanks very much.
Thank you for the question, Trevor. Yeah, you're right. This company has transformed. They still have sort of a tail end, a tag end of some tech hardware businesses. The Neptune water metering business is one that comes to mind, but a few others in the mix as well. But predominantly, they've been. This is a serial acquirer, is what it's pivoted to, an acquirer of vertical market software companies. In some ways, it's a similar business model to what Constellation Software here in Canada is doing. The difference is they tend to acquire much larger companies, and they're sort of secondary transactions, oftentimes from private equity sponsors when they want to monetize them. And they're sort of platform and network computing businesses that are ostensibly sticky recurring revenues and difficult to dislodge because they're mission critical. We sold this just as recently as last week or late the week before. We had carried a small weight in it for some time, and we basically have come to realize the AI threat is real. This concept of vibe coding and the possibility of small and medium-sized enterprises outsourcing coding of enterprise solutions rather than licensing them at higher cost. Is increasingly a threat to their entire business model. And so the shares are deeply discounted, but we're concerned it may be a value trap. It's always been low organic growth, but they seem to be reticent to pull the trigger on new acquisitions. Instead, they're switching to buying back their own shares. Feels like a bit of a Hail Mary pass the day after the Super Bowl, to use the football parlance there. So difficult decision, but we ripped off the Band-Aid and moved on from this one and took our lumps.
All right. Tony is calling in from Montreal with a question now. Hi, Tony. What's your question?
Hi. How are you? Good afternoon to both of you. And it's Bombardier. They're doing phenomenal defense after service. They just acquired somebody in the States today. The only thing I think holding it back is the tariffs of Trump, threats and all that. Where do you see it going in the next little while?
Yeah, that could be a hurdle. What do you think about Bombardier and everything that's happening with that company?
Yeah, great question. Thanks for that one, Tony. We like this. We've owned it for over a year and a half. Attended their investor day in Toronto, middle of 2024. They're doing very well. They're the best player in private aviation. Of course, they sold off the commercial aerospace and the trains business, and long before that, the jet skis and skidoos and so on. The Trump tariff threat. So, every once in a while, Washington tweets out something absurd, banal. Last week was no exception, trying to shore up the order book for Gulfstream, which is, a competitor to Bombardier. There's really no jurisdiction for the president to ground a fleet of aircraft. So, we think this is a taco, Trump always chickens out sort of opportunity. And Bombardier is not retrenching. They made that acquisition in the U.S. just today. So we like what we see here, and we continue to own the shares.
Okay, thanks so much. We're going to take another quick break. When we return, though, we'll take a look at some of Brian's new top picks. That's next. Join us tomorrow on Market Call. Julien will be on the show. He's Vice President at Equity Analysis at Goodread Investment Counsel and will be taking your questions on U.S. equities. Of course, Brian Madden joining us today in studio. Time now for his top picks. So we'll start with your first one, obviously, Shopify. What do you like about Shopify?
Oh, Shopify, great homegrown Canadian success story. This is the gold standard in e-commerce enablement services. Originally catering to small and medium-sized enterprises, but increasingly very large enterprises via tiered price point, monthly recurring subscription fees for basic website enablement. And then the add-on is what they call their merchant services solutions. So these are things like payments, working capital financing, artificial intelligence tools. The company has a large and ever-expanding partner network. It's got an aggressive international expansion strategy. And then, of course, there's just the long-term secular tailwinds for e-commerce adoption that are advantaging them and point to a growing total addressable market. And ongoing innovation is enabling ever broader merchant use cases, and that's allowing them to expand what they call their take rate, or the percentage of gross merchandise value transacted by merchants over their platform. It started sort of 1 point something, and now I believe it's pushing up closer to 3%. And so all this is rolling up to, in our view, what we expect is going to be a 33% compounded annual earnings growth rate over the coming 3 years. Now, you can say the stock is, priced dear, and it always is. Right now, we see it trading at 58 times forward earnings. That is at a historic discount to its 5-year average PE ratio of 70 times. And we think it's compelling relative to the earnings growth opportunity in front of it. So this 40% pullback is as steep as we've seen since this cycle started in 2022. So good entry point.
Okay. Next up, Service Corporation. What do you like about this one?
Much less exciting. This is like death and taxes. This is the number one operator of funeral homes and cemeteries in Canada and the United States. It is, yeah. So there's 2,000 sites here. They have a 17% market share. That makes them the largest player. It's a fragmented industry with lots of mom and pop single site operators. There are two other consolidators. Those are Carriage Services, which is public, and Park Lawn, which was taken out by private equity. Both these companies got themselves into some financial difficulties after COVID, which forced the retrenchment in their growth and ultimately the takeover by Park Lawn by private equity. Service Corp, we believe, has a size and scale advantage, which allows them to earn a premium level of profitability. The 30% and rising return on shareholders' equity is evidence of that. And so things like procurement and shared services are some of the sources of advantage there. They're also advantaged by their innovative pre-need sales strategy. And so we see them settling back into their normal 8 to 12% earnings growth rate algorithm after a couple of years of, I hate to say this, but demand pulled forward by premature deaths and COVID. And the shares are starting to break out nicely. So we see this as a quiet little outperformer here in this market.
Okay, last up is Lennox. What do you like about Lennox? Why is this your pick?
So this is a heating, ventilation, and air condition manufacturer and distributor. It's hard to think about air conditioning after the deep freeze we've endured here in Ontario, but heating is certainly top of mind. But this is one that's secularly advantaged by climate changes. More and more temperate regions need bigger and more powerful air conditioning units for longer and longer periods of the year. 75% of their sales come from replacement parts on existing units, and the other 25% is tied to new construction. They serve both the homeowner market and the large industrial applications market. To serve that market, the commercial systems market, they've ramped up a new facility in Mexico. They're taking share in the emergency replacement demand part of the market in that segment. And similarly, this is a market and an industry that's coming off of cycle trough conditions. There are only 7.5 or so million units sold in the U.S. last year, as housing demand has been very depressed. Normal sort of through the cycle average is about 9 or 10 million units. So we see this company sort of renormalizing and re-accelerating back to a high single digit or low double-digit rate of earnings growth, and the shares moving commensurately in tandem with the earnings.
Okay, that's all the time we have. Brian, thanks for coming in. Appreciate it. And thank you for watching Market Call. Trading Day is next.